Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of LME 3-month copper, aluminium and lead.
Hello and welcome. Before we start, I just want to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of these patterns, levels, analysis, or any related items on these my charts. This was all my own original work, as I think you deserve to have that. So with that, LME 3-month copper. The supports on this market continue to be the same as they have been since mid-May, and possibly, if you take out one aberration, since late April. They are the green short medium moving average, which is currently at 97.65, which the market has repeatedly pierced, including last week, but which has still shown the gradual angle of the move higher. Then there is the mauve medium moving average below the market, currently at 96.37, which held up the market as recently as mid-July and early August. We also have the bright red neckline extension a little lower, which is currently at 95.85 on November 24 to February 25, reverse head and shoulders button. And a further down, the gold long moving average, currently 94.59. Added to all this, at the start of July, prices rose up into the overhead band of congestion between 97.50 to 99.95. An area I described 11 weeks ago as a gossamer area, even closing over it, but it closed only the once, back in early July, and then prices came back down to rest on the previous well-highlighted congestion zone below, between 93.95 to 96.06, which contains a 50% Fibonacci line of the October 23 to May 24 move at 94.80. Now, prices since late June have yo-yoed between the overhead 97.50 99.95 congestion area and the 93.95 to 96.06 congestion zone below, though I do note possibly with somewhat decreasing amplitude. Nevertheless, for good order's sake, I will repeat once again the three congestions which we seem to be working our way up through. The first was way below, and that's between 91.83 to 91.86, and is the weakest. The second is the already mentioned area between 93.95 to 96.06, and is the one we became clogged down within over April and May, and from which we have moved up and away from. The final one is the one we are trying to work our way higher through, and so far seem to have failed, even though we're at the top end of it, and that's between 97.50 to 99.95. Overall, we have been chewing our way up and down through these for quite some time now, but so far we've not managed to break out of them. LME 3-month aluminium. As I've stated here many times, there are a number of patterns here, one within another, all happening at the same time, all affecting the market in their own way. And I thought for the last few weeks that the picture may be starting to get clearer, but looking after the last few days, and well, maybe it's becoming murky once more. Of all the features, by far the most consistent one has been and still is the bright red, shallowly bullish shift pitch for the mid-December 23 to late July 24 move. For a while in March and April, we moved below the overhead bright red middle time, currently at 26.97, and down towards the bright red lower time below, currently at 23.88. But this held, and we've moved back up, close once more to the overhead middle time. Nearer and below, we have the support of the flatlining gold long moving average, currently at 25.66. Now, the gold long moving average is within a small congestion band between 25.63 to 25.81. Interestingly, the rising green short medium moving average, currently at 25.99, which in the past really didn't look that great, had risen enough to initially reinforce the gold long moving average, but now seems to be starting to become an immediate support, if not necessarily a good one. Further down is the now flatlining mauve medium moving average, currently at 25.32, which also doesn't look that great, though it is just above the interesting 50% Fibonacci line for 2025 at 25.18. I suspect the next decent band of support further down is the one created back in May and early June between roughly 24.41 to 24.85, though I could be wrong. Looking overhead, we have congestion at 26.50. That's just short of the big old 50% Fibonacci line of the 2008 to 2022 move. Yes, it's that old. At 26.75. Now, separate to this, we also had a mid-April to mid-August dark blue bull channel, currently 26.59 to 28.66. The lower trend line looked solid enough a few weeks ago. However, prices managed to punch down and closed below the lower bull channel line, and the market is now establishing itself below it. In the process, the market initially, and again 2 weeks ago, punched down through the gold long moving average, but has since seemingly tried to travel along the underside of the broken dark blue bull channel. I said 2 weeks ago how all this action created the opportunity for two patterns in a relatively short amount of time. The first was to regard the action throughout August as a possible small double top, with a final potential below the mauve medium moving average. I did not set targets for this back then, as it was not confirmed. Since then, we have had a move lower, below the neckline for the double top, but it was short-lived, and at most only came close to the primary target and nowhere near the secondary target. Thus, this pattern, though created, has not fulfilled all its opportunities on the downside. Secondly, was to look at the whole late June to date action as a possible complex head and shoulders top, with even further implications below than the possible double top, though it could potentially be a continuation pattern. Likewise, in this case, it was 2 weeks ago, too early to talk about the targets below, but I did add, and I quote, I would suggest looking at the flatlining gold long moving average as a proxy for the neckline until a proper one is established, with all the implications such a move lower may have. Thus, caution on the downside. And that's the end of the quote. We have not lived up to that opportunity below, and I will be retiring this pattern idea after today. LME 3-month lead. Mid-April bull channel saw the market breach lower on the downside 5 weeks ago, then seemingly repaired only to finally break lower a further 5 weeks ago. This trend line was originally seen by me as part of an ascending triangle pattern between May to June, but since developed into a mid-April to late July bump and run reversal top pattern, as well as part of a not finished bull channel. Now, going to the bump and run reversal pattern, as I said 5 weeks ago, and I quote, if this pattern decides to follow through on the downside, then we will have a primary target X down in the 1964 zone, just above the bright red extension to the August to December 2024 head and shoulders neckline, and a secondary, harder to reach target X1 down at 1916, coincident with the low of January this year. End of quote. The second concerted attempt lower in early August travelled further down than the one in mid-July and reached the bright red neckline, currently at 1959, of the August to December 2024 head and shoulders pattern. In the process of tripping lower, the primary target X at 1964 was reached, but that was all, as prices have since then moved back up, hesitating around the various moving averages overhead back then, and importantly making lower highs and messing with the previously highlighted congestion between 2001 and 2003. Now, looking further up, we have congestion between 2036 and 2039, including the January 2021 high at 2039 and then at 2060, which was breached but which eroded the bullishness, even though that we formed a horn top, well, enough of it that we formed a horn top back in early July. Now, there's one further feature, and that is the exit pattern from the bump and run reversal pattern. It was made with a mid-July to late September dark blue descending wedge pattern, currently 1935 to 1975. This pattern looked like it was becoming established, though it crucially does not have the full 5+ touches of both sides necessary to call it fulfilled. However, I've chosen, for now, to still keep it on my daily chart. Though with this and the way prices have strolled out the top side of this pattern, I'm inclined today not to set up potential targets above, not yet at least. There was also another pattern, one I now believe is no longer valid, is to look at the last two peaks since mid-July as a possible cat's ears pattern, a bearish pattern akin to a double top, but only after forming a decline, as we saw in early and mid-July, and then the double top coming in, and that's the cat's ears pattern. 2 weeks ago, I cautioned to watch out for this pattern developing, as the bright red neckline previously mentioned could also be the neckline for this pattern. Well, it has failed to develop, and I'll now be retiring this idea after this commentary. Finally, there is one additional point I would like to make, and it is a point that I've been making here since the start of this year and will continue to do so going forward. It has been and still is to me the most important point of all. So, at the end of December last year, we saw that 2024 had created here a very large and rare annual key reversal down in LME 3-month lead. Hence, one should look at all things going forward this year in this metal in the shadow of this longer term bearish pattern.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.